The 29th episode of the Justin Spaulding Show. We're now in session, July 9th, 2021. Hope you guys had a great 4th of July. Hope that there was no fingers blown off or anything like that. I know there was some NHL guy died.
Died?
Yeah, there was a firework that him and his friends lit or something like that, and it came out the side and hit him in the chest and died. Yeah, so that's scary. But hopefully it was a safe and enjoyable 4th of July. We had some people over, took the boat out, had some fireworks. Ate some food. I had way too many freaking cookies, Muddy, and I had probably had I bet I had 25 Oreos. I bet I probably had 5 chocolate chip cookies, and I bet I had 8 chocolate chip M&M cookies. So really overdid it on the cookies. So that's my cookies for the next 5-6 months. I think I gotta take a little break now, get back in the gym. You know what I'm saying? Speaking of the gym, I got a couple workouts in over the weekend though too, pumping the iron, you know? So feeling good around here. So 29th episode already, the Justin Spaulding Show. Thank you guys so much for joining. If you're joining, and watching this live right now, thank you so much for joining. If you're listening, and I like to always think about this thing being listened to in 2028, well, I hope you're having a great day in 2028. And I hope this stuff is still relevant and still helping a lot of people. So we're gonna dive into some questions. There were some questions that were submitted by our listeners and watchers, and so I appreciate you guys for doing that. Man, whenever I ask for questions, just submit questions, because this is where I'm gonna, so many people are DMing me stuff every now and then. I should just start screenshotting those more often, but like specifically in my Instagram story, if I'm asking for questions, it's usually because I'm wanting more questions for the podcast. Hey, it's a great time for you to submit your question if that thing comes up. So never hesitate, just push the button and leave your question. Maudine, let's get into the first question today. First question is, how does one go about collating with you on investments? I don't know if collating is the right word to use there, but let's just say, how do you get involved in investing with us? Well, right now, the way it is, you got to be accredited, all right? Accredited investors only right now. Now, I do have the ability to make the exceptions for a select handful people, but we're going with accredited. What's accredited? So accredited investor, you can look it up. If you Google what is an accredited investor, it's gonna show you all the ways that you can be accredited. All right. Let's just do this right now actually. Here, Maudine, earlier than anticipated, let's bring up my screen. What is an accredited investor? Right? And so an accredited investor, a natural person with income exceeding $200,000 each of the 2 most recent years, or the joint income with a spouse exceeding $300,000 for those years. So that's kind of the general broad description of what an accredited investor is. I didn't hide my screen really quick because I'm going to bring up what our actual sheet kind of looks like, and I just don't want everyone seeing this. I'll bring up right now, if you're listening, you're going to have to go to YouTube. And you're gonna have to find this if you want to see what we're seeing right now and what our audience who's watching is seeing. You're gonna have to go to YouTube and check this out, because I'm gonna bring up our actual document. So when someone wants to invest with us, so going deeper into the question, right? You gotta be an accredited investor. Well, when you want to invest with us, we send out a private placement memorandum to those who are accredited. And the private placement memorandum basically describes the opportunity that our company is offering to accredited investors. And then once they agree and they want to be a part of it, you basically sign some docs, you send us the money, and you're ready to rock and roll, right? You set it and forget it. Never forget your money. Just kidding. Do not ever forget about your money. Even when you write someone a check, I hope that you're following up. I hope that you're asking questions. If you're investing money, you got to be able to pay attention. But you set it, and you're going to get the cash flow monthly, right? So now, I'm going to find this document real quick. Share my screen, Maudine. I found another resource that has more of them listed. So here is the 2021 definitions of an accredited investor. A net worth in excess of $1 million, not including primary residences. Right, so once again, just going side note, right? I think I brought this up last week too. Side note, this is another reason why the house that you live in is not an investment. It can't even count towards your net worth when your net worth is pertaining to being an accredited investor or not. What a joke. Historic and expected income over $200,000 for an individual or $300,000 for a couple. So that makes you accredited. You don't need both. You don't need to be $1 million net worth minus your primary residence and income over $200,000 a year or $300,000 for couples. It's just, it could be, maybe you're not at the net worth of 100,000 or a million, but maybe you make $200,000 a year, you're accredited. If you do not make $200,000 a year, so maybe you make $120,000 a year, but you do have a net worth in excess of $1 million, you are accredited. So it's basically just hitting one of these circumstances. An individual holder in a good standing certain So basically people, they also count accredited investors someone that just has the knowledge, right? Knowledgeable employees of a fund with respect to investments in a private fund, right? So people that are close enough to it who don't make $200,000 a year, who are not net worth $1 million, but they're tied in enough with the company, they're an employee of the company to have an understanding enough of the investment vehicle or what it is that we're investing in. For us, it's real estate, right? So if it was someone that's on our staff that is a regional manager, and if they're not making $200,000 a year, they don't have a net worth of $1 million, they could invest because they're a knowledgeable employee, right? An executive of the issuer of an executive of the GP of the issuer. So again, someone that's on the inside. And then now there's also accredited investors that are entities, right? So most people think, oh, individual. All right, well, yeah, there's an accredited investor that's an individual, but then also there's accredited entities, and that's any business, trust, partnership, et cetera, worth more than $5 million. An entity in which all the equity owners are individual accredited investors or family offices with at least $5 million in assets under management and their family clients, right? So there's a lot of different ways that you can be accredited. But you can go back full screen to me. So first things first, you gotta be accredited, then you gotta agree with our terms, right? Now our terms are, and this can change, our terms can change. Other people might have different terms than us. But once you're accredited, once we send you the private placement memorandum and the operating agreement and the subscription agreement, if you agree to the terms that are in those and you like the deal or the business or whatever it is that we're investing in, you like the prospects of that business plan and you think that we can execute on the business plan, then you just write the check, you submit the docs, and you're in. Our terms are as such, so far they have been as such. They could change in the future. They're subject to change, right? Now, once we close a fund, once we close a deal and all the docs are signed, those terms can't change. Going forward on new deals, they could change. Historically, it's been we pay a 6% preferred return. So if you're accredited, you like the prospects, you like the idea, you like what we're investing in, you want to invest 100 grand. That means you'll get a 6% preferred return, right? 6% of $100,000 is $6,000. You're going to get that in cash flow as a preferred return. Now, we're not guaranteeing you're going to get that. There's no guarantee out there saying we have to pay you that, right? The cash has to be available from operations, and then we would pay that to you. And then everything above a 6% preferred return is split 70% back to the investors, pro rata, then 30% back to our general partnership group. So there'd be a profit split. So for us, for performing and getting you paid, we get more of the upside, right? The better this thing performs, the better that we make it crank, the better that we make it operate, the higher of a sale price that we get, the more money we make you as an investor, the more money that we're gonna split once we hit these different tiers. That first tier being a 6% preferred return. The second tier is once the investors have a 12% annualized return, it goes to a 50-50 split going forward. Right, and then on top of that, we get a 1% acquisition fee on the purchase price of the deal. We get a 1% disposition fee on the sale of the deal, and we have a 25 basis points or 0.25% asset management fee on the total capital invested, and that's annually. So if we raise $10 million in a deal, 1% of that is, so we basically get 25 basis points of 10 million, which is $25,000 a year to basically manage the money and help with operating expenses and et cetera, right? Which we're very, very, very competitive in our fees. I guarantee you that. Our investors tell us that. The market tells us that. My research tells me that. So that's what it kind of looks like. That's how you go about investing with us. I hope that we at some point in the future do and can get unlimited unaccredited investors involved, I think that'd be a lot of fun to open this thing up to people who don't, that's the thing, is the game is rigged. The game's rigged, right? So what are you gonna do? Are you gonna cry about it? Or are you gonna find a way to become accredited? Are you gonna cry about it, or figure it out, right? And so, but that being said, we do want to work on getting unaccredited people involved as well. People are like, well, why don't you just go ahead and open up the unaccredited? Open it up for unaccredited investors. Well, it costs more. The government is funny that way. They want to keep you out, right? Wall Street wants to keep you out of investments like this because Wall Street wants you to keep putting money in your Roth. They want you to keep putting money in your 401k. They want you to keep putting money into things like that because they want to keep control on it. They want to keep their management fees. They want to, in a sense, I don't know, in my opinion, I think they want to hold people down. Anyways, Muddy, next question. So this question, I guess, came from the same person and says, also, do you offer advice on current flipper/time to sell? Do I offer advice on flips? Yeah, I mean, I offer advice on flips. I'm in a flip right now with my buddy, and he's asked a couple questions here and there, but not really. He just kind of goes out and operates it. But yeah, I mean, I work with other people that have taken my courses, have taken my coaching, and all that stuff, and they flip. The biggest piece of advice I have for people that flip is the smaller the deal it is, right? The faster you want to be in and out of it. So if you're looking at flipping single-family homes, yes, get in and out of that thing really fast. Don't view it as a true long-term investment. View it as a way to accumulate more cash, just like working a job, right? View it as a way to accumulate more cash to then put to work in a more long-term cash flow producing type asset that can appreciate over time. Now, there's no specifics on that question, so I don't know what exactly, do I offer advice? Yes. I mean, I don't know how much further I can go into that question because there wasn't much context there. Do you think, Maudine? Wasn't really much context there. So yes, I can. I need to know more specifics, though, of the situation. Real high. Again, if you're just starting, the faster that you can get in and out of deals to acquire more capital to go get bigger deals, that should be the strategy there. In and out, in and out. If it's a single family, get in and out of it. If it's a duplex, get in and out of it. If you invest in a 200 unit, you don't necessarily have to get in and out of that one. I would consider holding on to that one for a little while. But to get into the 200 unit, you might have to flip 1,000 homes. You might have to flip 500 duplexes. You might have to flip 254 units to get there, or raise some funds from some accredited investors, right? So when it comes to that, that's all the advice I have from that high level standpoint of do I offer advice on flips? Yes, I do, but I need more context than that. Maudine, next question. Maudine, Bucks or Suns? So when we're filming this, it's July 6th. So I know I said July 9th. It's our 29th episode, but we're really filming this a little bit early, then it's going to be released. So game one is actually tonight, and I'm going Bucks. I'm going Bucks for game one. I'm going Suns game two, and then I got Bucks winning 3 in a row.
3 in a row?
Yeah.
Damn.
So Bucks and 5. Everyone likes Bucks and 6, Bucks and 6. Bucks and 5 is what I'm saying. So Giannis is actually questionable for tonight.
Is he? I think he's out for a month.
Well, he was listed as doubtful the other night when they beat the Hawks. And now I just saw an injury status report this morning or whatever earlier today, and they said he's questionable, meaning he's got a shot to play tonight, but I don't think he's playing. But if he's updated to questionable, then maybe that means, game 3, maybe he's back. We'll see. They played pretty good without him the other night. I think without him, there's more ball movement, right? The ball is flying around the court. More guys are willing to step up and take shots. And we have some, we got some players. We got some shooters. We got some, when Giannis isn't there, Brooks gets to stay in the lane a little bit more and not have to be pushed the perimeter so much. And yeah, we're going to see what happens. But I got Bucks winning game 1. Got the Suns winning game 2. And then I got the Bucks winning 3 straight. I'd love to get to a game 4. Hopefully I can get to game 4 in Milwaukee. So I got my sister's wedding coming up this week, and hopefully I can go to game 4. So next question. How do you analyze off-market deals without seeing any of the major details, rent rolls, etc.? So this is where you can share my screen again, Maudine. this, when you get good enough at this, when you do this enough, it takes time, but when you do this enough, you should be able to basically underwrite almost any deal and be very, very close on what you should pay for it. You could pretty much, if you put me in any property in South Central, Madison, Janesville, over the Milwaukee area, South Central, Southeastern Wisconsin, I could just set me there, and you don't give me any numbers, you don't give me a rent roll, you don't even let me look it up online. I could probably be within 5% to 8% of what that asset would be worth, pretty quick. And so, if you're not right on site and you do have access to apartments.com, one thing that you could do is, here, let's just do this. Let's go Madison, Wisconsin. We're gonna search. We're gonna go to here. I'm gonna pick one that's in Florida. I'll do Florida, just to show you that this doesn't, I'm gonna take myself out of my market, just to see to give you an example of how I would come up with some initial underwriting or have an idea what something's worth, just looking at it. All right, here's a property right here, Felix Apartments. Here, actually, I wanna go a little bit closer. Let's do this. Let's go, what do we got right here? What's this asset right here? What's this asset? That's not what I want. Hold on, I'm gonna go types, I'm gonna go apartments. I want to get rid of the homes. I don't want any single family homes in this. Let's go along 95. Scroll in a little bit here. Let's look at something along 95 here. All right, canopy at Belfort Park. Let's kind of just take a look at this one, all right? So this is kind of how you could come up with some underwriting. Now, obviously, you don't want to just buy a deal off this, but you get to a standpoint where, like, the faster you can come up with a number, the less crap you give a seller, the better it's going to be for you. Because there's deals in Janesville where I'm operating, in Madison. There's deals where literally I can, on a napkin, basically come to an agreement with the owner and basically say, hey, as long as there's not something drastically, like, just glaring a huge issue when we do our inspection and we go through our due diligence, this is the pricing. Now, doing this for an asset in Florida, right, the first thing I want to do is, okay, I can go to apartments.com and this canopy at Belfort Park in Jacksonville, Florida, right? If I scroll down here, I can go to about, let's see, contact amenities, fees. I should be able to find how many units there are. All right, so right here, I got 192 units, right? So I'm gonna take my calculator right now. I'm gonna go 192 because we've got 192 units like you're seeing right on the screen. It's built in 2013, all right? So that shows you about the vintage that we're looking at. The other thing, I wanna just make sure that we have washer dryer in unit. Yep, washer dryer in unit, all right. Monthly rent. All right, so right here. So I can't even, so some of these listings on apartments.com, they let you break it out. They let you click on 1 bedroom, 2 bedroom, 3 bedroom, whatever. They let you be more selective. Well, right here, this is all they're showing us. Because right now it says pricing and floor plans. There's no available floor plans or units available right now. So the place is full. But this is the cool thing, is it shows me how many 1 bedrooms, 2 bedrooms, 3 bedrooms. There's 66 1 bed, 1 baths. The average is 690 square feet. There's 2 bed, 2 baths. There's 96 of those, and then there's 30 3 bed, 2 baths. And it shows me the square footage. Now, if this was my market, if Jacksonville was my market where I'm actually operating, I would pretty much know on a square footage basis how much a 1 bed's going for, 2 bed, 3 bed. I'd pretty much know what it was going for. I know how many units there are, right? So I just go 66 times the 690 square feet times my rent per square foot, right? I'd be able to figure out the total rent. This is not my market. So what I'm gonna do is I'm gonna take what they've got here for monthly rent. Now these are ranges on the previous, what I've got highlighted right here are ranges of the previous listings they've had on this website, right? So for high level, what I'm going to actually do is I'm gonna take a number that's kind of right in the middle of that 1,132 and 1,589. And actually what I'm gonna do is take a number that's, So there's less 3 bedrooms that are 1 bedroom. So I'm going to take a number that's maybe just below, just shy of the midway point. So if the midway point is, let's say, 1132 plus 1589 equals 2,721. Let's divide that by 2. The number that's in the middle is 1360. I'm going to take 1345. I'm going to take 1,345 and say that that is the number that's the average rent. Is this making sense, Maudine?
Yeah.
That's the average rent of this place, right? Really high level. Once again, this is really, really high level. You asked the question, I'm just answering it. Now, we're going back to how many total units we had. Shit, what was it? 192, right?
190, right?
We got 66 plus, here, I'll just scroll down to see this again. Yep, 192 units. So I'm going to take the 1,345 times 192. All right, so we got $258,240 per month in rent, right? That's just rent. Now let's multiply that by 12. That's $3,098,880. Now, some people are like, oh, okay, that's the rent. But you know what? If you've ever lived in an apartment community, you know that there's amenity fee. Usually when you sign up, there's an application fee when you're looking to apply. There might be a parking or an extra parking spot. There might be a pet fee, right? So there's other charges. So for this conversation, I'm going to say that annually there's, annually there is, let's call it $750. There's chargebacks. So if you damage your apartment, they keep some of that security deposit. Right? So there's other ways that they're making money here. They might charge back water, right? There might be rubs. So let's just call it $750 on top of the $3,098,880 that are available if it was 100% occupied, right? Which we're gonna come up with that which it is right now supposedly, but we're gonna account for vacancy in a second. So the gross rent potential is $3,098,880 for the year. Now on top of that, we're gonna add on to that big 3 million number. We're gonna add on $750 per unit per year. So 750 times 192 of other income. That should cover just about all of it. So now that takes the $3,098,880 gross rent number, that, and then add in the other income, that takes it to $3,242,880. Okay? So $3,242,880. So what I do there, that's if it's fully occupied, right? And that's close, right? I bet that number is probably within 3 to 4%. Right? So give or take 3 or 4%, that's probably how much revenue is coming off the property. I might actually be light on the $750 per unit of other, and that just kind of depends on the market. What are the other market amenity fees? What are the pet fees in the market and all that stuff, right? So now what I'm gonna do is I'm gonna take the $3,242,880 number, and I'm gonna multiply that by 0.97 because the Florida market right now is crazy. You're not going to get much of a vacancy factor. Now, obviously, you'd be able to verify that and stuff if you had actual performance of the property, whatever. Let's just take 97%. Let's call it 3% vacancy. So let's take 97% of that number, which that comes up to 3,145,593. So that's saying there's going to be 3% vacancy because I took 97% of the main number. Make sense, Maudine? Did I lose you there?
You lost me.
I lost you? So the rent, right, plus the other fees that we can charge, means that if the property was full every single night, 100% full, we never had any turnover, whatever, the property could bring in $3,242,880.
Yeah.
That's never the case, right? There's never going to be, even though right now this property might be full, there's going to come a time where 5 people leave or 12 people leave or whatever. So what we're going to say is we're going to say that there's a 3% vacancy.
Okay.
So the property's 3% vacant. That's going to be our assumption. So I can back out that 3% by just taking 97% of the 3.2 number. Does that make sense?
Yeah.
So 97% of the 3.2 number is 3,145,593. You know what else? So now what I'm going to do, actually, let's just, that's good. We're going to say there's $3,145,593 of rent that comes in after vacancy. So that's allowing for some vacancy. What I'm going to do then is I'm going to apply an expense ratio. Now, on an asset that looks like this, that you can see still on my screen, that's 192 units built within the last 5-7 years, right? You have some amenity space, okay. I want to see if there's a picture. You got, you have an outdoor pool. You got to take care of all that stuff, right? You have to maintain. That's why I'm trying to look at pictures here. I'm trying to see how much yard there is. I'm trying to see if there's a pond anywhere. I'm trying to see, which I can't see any of that stuff. So I don't know, So my best guess is that of that revenue that we're going to collect, the $3,145,000. For this example, I'm going to say that there's going to be 40. And at this rent level, I'm going to say there's going to be 44% of that number is going to go towards expenses. So that 44% number is going to go towards the management fee. It's going to pay the property manager. It's going to pay the insurance. It's going to pay the common area utilities. It's going to pay the water, the sewer. It's going to pay the trash bill. It's going to pay for the repairs, maintenance, and the paint. It's going to pay for removing junk that the tenant leaves when they move out. It's going to pay for the marketing. It's going to pay for, what else is there? The leaks. It's going to pay for, et cetera, et cetera, et cetera. All right? So, times. I'm going to say that, what did I say? What number did I say right there? For the sake of this, 43%?
You said 47.
40. All right. Now, giving you the example of what's included in the expense ratio, I lost my number. All right, so now bear with me again. I'm going to take, for this property, what I think is realistic, I'm going to say it's actually 40. I'm going to say 42% is expense ratio. So I can multiply that $3,145,000 number, $3,145,000 by 0.58. I can multiply it by 58%. Does that make sense? Because I'm taking 42% of it. Yeah. Is going towards expenses. So if I take 58% of the number that we had coming in revenue, that's going to give me what's left over after expenses. That gives me $1,824,443. Now that number that I have right there, that 1.8 number, the number that's just north of 1.8, that's the net operating income. All right. Now what I will do is I'll take the cap rate, and the cap rates in Florida have been crazy. So let's say it's a 5% cap rate, which right now it's probably actually, if this property traded, it'd probably be more like a 4.5 or 4.3 cap rate. But I'll take a 5% cap rate. So I'm going to take the 1.824 million, which is the net operating income. I'm going to divide it by the cap rate. I'm going to divide it by 0.05. Now the cap rate is basically, if it's a 5% cap rate, what that means, if I did not get a loan for this deal, if I didn't have any debt on it, that 5% is going to be my return. So if I paid for this property in cash, I'm going to basically get a 5% return. Now what's going to allow me, debt will allow me to actually have a higher cash on cash return because I'm using leverage, but cap rates are just, so the lower a cap rate is, the higher the price is going to be. The higher a cap rate is, means the higher return you're going to get, so you're paying less for the property for each dollar of NOI. Okay? So let's say it's a 5% cap rate, which is just technically, it's usually just based on the market. That gives us, so it's 1.824 million, 1,824,443 divided by 0.05 gives me 36,488,878 as the price. Divide by 192, $190,000 a unit. I know for sure I'm light on that because you're not buying anything in Florida right now for $192,000. I do think, this property, just based on the rents and stuff, I mean, in looking at it, it might be a property you can pick up for $205 though, so I'm probably within that 10%, probably within a 10% buffer on that. 8%, 10% buffer. So, but that's a good starting point though. That's how you potentially practice underwriting deals this way. If you can't go out and find any deals, whatever, this might be a great way for you to practice. Now, as we get more, and I think where I'm light on that deal is the other income is actually probably higher than 750, and that cap rate is actually probably lower. So the cap rate is probably, So if I take the 1,824,000, divide that by a 4.5% cap rate, that'd be 40,543,000 is the purchase price. Divide by 192. Now we're up to $211,000 per unit, which is probably closer to where we need to be. So that's how you do that. But as you dive into markets, you start to just get this and know it and understand it. As you start to operate the assets, you know what type of assets, based on the age, approximately what the expense ratio should be. And if the current property is not operating in that manner, it could be that there's something wrong with the property that you got to take care of and invest dollars into, or it could be that the management is just doing a horrible job and there's a huge opportunity for just a better management play to then reposition the asset to unlock a lot of value. Or you just don't buy the deal anymore if they're not budgeting their price because it's just not worth it. So that's a little bit how, go back to the question again, Modine. You can probably go full screen on me. So that's kind of how I analyze off-market deals without seeing any of the major details, rent rolls, et cetera, et cetera. Now, obviously, like once you, I've negotiated without seeing rent rolls and stuff off of just knowing the market and doing what I did right there, and and just got close with the seller. But then obviously, things are that's pending nothing big coming up in the due diligence, pending that the numbers are close and all that stuff, which you get due diligence, so you can always go back on that if you're way off. But that is how right there I would analyze deals. And once again, when you're in a market and the more deals that you do, like I'd be way closer on a deal that I just did right there if I actually picked Wisconsin and the markets where I'd be on the money on where it's going to trade at. I'd be pretty dang close. And it'd be pretty. I would know like what it would probably trade at if it was on market, and I know what we would also be able to probably buy it for if it was off market. Now I picked the Jacksonville deal because I just wanted to show you it doesn't have to be something that's in your back. You could be like, oh well, the market so well in Wisconsin. It doesn't have to be something that's in your backyard to have an idea. But but at the same time, you do need to know. You need to get into the game. You need to pay attention to what's going on in the news. You need to pay attention to what's going on in the markets so that you can do this. And the more that you know, the better position that you're going to be when you do or do not have all the blanks filled in. So next question, Modine. Did you like that, Modine?
Yeah.
Yeah, makes sense. Do I recommend starting small with a 4-unit plus or partner with others and go big, 32 plus unit? See, it's funny because 4-unit, I answer this question enough, so I think I'm going to spend more time on perspective, because a 4-unit to some people is big and a 1-unit is small. For this guy that asked this question, he says something small like a 4-unit or big like a 32-unit. For me, right now where I'm sitting on 32-unit is small and 400 units is big. But I'm a little minnow still, and there's people that are playing a game where it's like, 300 units is small, and we're going to go buy a 1,100 unit property. Right? So it's all perspective. The more doors, so instead of just saying bigger, whatever, and using an actual number, I'm just going to say this. The more doors, the more that you have on one site on your first deal, the better. Now, there's some room for, if you make a bigger mistake and you forget something or leave a 0 out, that's a big mistake, obviously, right? So you could have a bigger mistake there. But if you can close the deal right, it does not take you any more effort to run a 40 unit as it does the 20 unit. But you're going to have a lot more upside in the 40 unit. It's going to be a lot more worth your time. And actually, as we've scaled from a management standpoint, it's gotten easier for me as we've done bigger deals. It's easier now at 900 units than it was at 200 units because we have a staff, right? So we've got scale where we've got a staff, and now we're getting to the point where we're getting to the scale where we're starting to hire. We're going to hire some floating type employees where it's a floating maintenance tech, meaning, hey, you got to be ready to travel to any of these properties to help out as needed. A floating property manager, hey, you need to be able to float to have these properties that are in need at this. You can't do that at 20 units. right? So get over like the bigger, smaller thing. Just understand that the sooner, it doesn't matter how even, the sooner, whether you have to partner with someone or whatever, the sooner that you can get more doors, the better investment that it's going to be. The more scale, I just got off the phone with, I just got off of a Teams call that lasted, an hour with a guy out in Los Angeles, and his family, they own $2 billion of real estate, and that's all. Like the main takeaway from him is he wasn't like, he understand my level where I'm like, I already understand that the scale is important and it plays a big factor in how successful you can be in your upside while also limiting downside. But without directly saying it, he talked about how important having scale was and using that scale and using those synergies to be successful and to take risk off the table. And he's a guy they got $2 billion or $3 billion worth of real estate, right? So every single day, it becomes more and more evident that scale we saw it in our veterinary business. Like the more scale we had, it was crazy what started to happen and the conversations that you start to have when you have more scale. That's why with Prime Painters, I'm trying to figure a way to get more scale. And right now, the only thing that's holding us back is figuring out this frickin' production thing to get enough painters or to get enough subcontractors to crank out work, because we can sell the work right now. I want the scale. Because when I have the scale, now I can go back to our vendors and say, hey, like we're gonna bring you this much. I want this much of a rebate. I want my pricing to be this, right? And in exchange for the most competitive pricing in these rebates, I'm gonna buy as much as I can from you. I'm gonna buy the paint from you. I'm gonna buy the ladders from you. I'm gonna buy the ladder stabilizers from you. I'm gonna buy everything. If you sold trucks, I'd buy the trucks from you. You probably, some vendor, the vendor I'm talking about right now doesn't sell trucks, but with more scale, right? I'm gonna get a lower price. Now think about it. Now let's think about this quick. I'm just gonna throw random numbers out there real quick. All right, but let's say your material cost in whatever business is 25%. Okay. This is just a number I'm pulling out. It has nothing to do with painting or real estate or anything, any business. Let's just say your material cost of whatever you're building is 25%. And you're $1 million a year. And so when I say 25%, it means it's your material expense is 25% of the revenue that you have as a business. All right? So 25%, you have $1 million. So that means $250,000 of that million is paying for the material to make the widget. Right? Now you have another 25% of expenses that are people and whatever, right? You got rent to pay and insurances and shipping and whatever, all this stuff, right? So you got a total of 50%, 500,000 of the million is expenses. 25% of that 50% is material. Now let's say by scaling up, and this is real, this is not hypothetical, but by scaling up, and if you have 5 million, you have $5 million of revenue. Which means, if those percentages stayed the same, where the 25% for materials stayed the same, it would be 1.25 million in cost for materials. But because you drove more business to that vendor, you're gonna be able to negotiate rebates, you're gonna be able to negotiate better pricing, and that might drop 10%. That might drop 15%. You might be able to get that cost down from 25% down to 20%. Now your cost of materials just went down 5%. So you saved 5%, but you didn't save 5% on $1 million, which would be 50,000. You saved 5% on 5 million, which is 250,000. That is scale, and that is 100% true. So no matter how, I can't remember the question. Oh, this stemmed off of, should I have a, whatever, how do I get started, smaller bay?
No, that's the next question. Big or small?
Yeah, big or small. And I'm done answering that straight up question because everyone should know where I'm standing. I'm just diving deeper into the why, the scale, and I'm all about the scale and why anytime I talk to someone that's got more than, that's out there successful in the marketplace, guys that have $2 billion, $3 billion, $5 billion, $10 billion worth of assets and are worth, people that are worth $100 million, hundreds of millions of dollars, billions of dollars, because they're talking about scale too. They don't become multi-millionaires, centimillionaires, deca millionaires, billionaires by no scale. It's a scale game. And then you start to separate yourself. Right now, if I free up that extra 5% on $5 million, right, which equals $250,000, what does that mean? That means I could probably take half of that 5%, 250, let it fall to the bottom line. I could take the other half and invest back into my company, into more people, into more capacity, into research and development, into marketing and advertising, into branding, right? Which what does that do then? That then takes my 5 million up to 10 million. And now that I'm at 10 million, I got even more scale. And you know what? Instead of 20% of my cost of that 10 million, 20% of that 10 million going to the material cost, it might drop to 18%. So now I just saved another 2% on 10 million. 2% on 10 million is another $200,000. No. Yeah, it is. 2% on 10 million is another $200,000. So as you start to scale, and that's just, that's a, it's not a hypothesis. It's real. Scale is real. So however you can get to more scale, the sooner the better. Now once again, I'm not getting into what is scale, because that's different to everybody. I get it. Like, so you got to also be able to get your foot in the door. So if it's starting with a 2 unit or a 4 unit or 8 unit, wherever you got to start. But then scale. Find a way to scale. The smaller it is, the smaller that you start. Remember what I said before about flipping? The smaller it is, get in and out faster. Have the plan, right? Have a plan to get in and out faster, but also be prepared to hold on to it for the long term in case something changes. If you can, get in and get out, get in and get out. If you can buy something today that's worth $200,000, you buy it, it's cash flowing, you can sell it 9 months from now for $250, sell it. Get your initial money back plus the extra 50, and now go buy the 4 unit that you pay, go buy the 8 unit that you buy for $400,000. And then hopefully, 18 months after that, you can sell that for $550. Now you get back the initial money you put in plus the extra $150 on top of for the appreciation, right? Plus the equity you'd unlock from your tenants paying down debt. Keep rolling until you get scale. If you're in a painting business, if you're making whatever widgets, find a way to scale so that you can get better pricing, so you can get more synergies, so you can hire more people, so you can build a better infrastructure. Scale, 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 scale. Next question. What was the biggest challenge starting out? For me, the biggest challenge, I think this changes depending on what I'm going through in the moment and when I reflect back, because I think I reflect back on different parts of my journey depending on what's going on in the day right now. I think, the biggest challenge starting out is just once again, starting out. Like, just doing it. Just go out and do it. Like, don't wait any longer. Go find a way to start that's going to put you on that path, right? Learn. Find a way to make money. Go out, save that money and stash it up. Go out and start looking, right? And this can be a lot of different places. Like, it can be, I know what trading cards is big right now. The NFT stuff is big right now. Like, if you're good at that stuff, like, start flipping it. Start flipping it. Like, Gary Vee does the garage sale thing, right? I mean, if you need to do that. And you can scale that way. It's real. You can spend 10 and turn it into 100. And you take the 100, okay, how do I turn it into 200? How do I turn it into, you don't have to, outside of your main job right now with 3, 4, 5, 6 hours a week, how can you start to multiply some money? Buying, selling, trading. Right? There's the one guy that traded a paperclip all the way up into
Tesla? Or no.
Was it a Tesla or something? What do you end up trading it to?
One girl went from a paperclip to a house. One guy went from a cup of sand to a Tesla.
Right.
So
but that's the thing is find a way to. What they do the whole time? They were scaling up, by the way. Right? They were trading. They were scaling up. So find what you're good at and just start. The biggest challenge for me was just not I started young, but I still could have, no doubt I still could have found a way to start in college. Even when I was playing college football, I could have found a way. I I mean, what I should have done, I should have just started a lawn mowing, snow removal business in college, and that's what I should have done on the freaking weekends and in the morning. I started saving up money, going looking at deals, right? Hiring other people then at that point to go shovel it for me, right? So I could have done that. I could have gone out to garage sales like they're talking about now. I could have done that stuff and listed. Facebook was still, people were listing stuff on Craigslist and Facebook back then. People had garage sales. I could have figured it out. Drop shipping was starting to be big around then.
That now.
But
Maybe.
you got to just start. You got to just start. And I don't want you to think, oh, but I can't because I can't just jump into duplex. Okay, well, what's the next thing that puts you on that path? Like, what is it? And then go start. All right, next question. Advice for brokers to take you seriously when you do have money but have not done deals. So, okay, here, you want some advice? Put in a competitive offer. Don't lowball it. Put in a competitive offer. And then go in with money hard. If you have the money, go after it. That'll get their attention. Hey, I'm gonna, oh, okay, you say he wants $10 million. Okay, here's 9.75 million bucks, or here's 9.85 million bucks. Here's 10 million bucks, right? Here's the purchase price. 10, that's what I want to buy it for. All right. Earnest money of 1% of that, so $100,000. All right. Of that 100, have part of it go hard right away. 10,000, 20,000, 50,000, all 100. I think they'll take you serious at that point. If I don't close on this deal, if I back out for whatever reason after we sign today, and the guy gets to keep $50,000, my $100,000 deposit, no matter what, I think that broker will take you much more serious. You have to take action. That is what's gonna. Everyone has money right now, so they're gonna go with the people that they know have closed or that are super serious. Like what? I haven't. Now that being said, I've never had a deal go hard. I haven't had any earnest money go hard at all from day one. I've had it go hard in the middle of due diligence or whatever, where it's like, okay, now I'm out 50,000. I mean, that deal we did back in January, I think I was out 100,000 30 days into that deal, and if it didn't close after that, it didn't close for another 30 days after that or 45 days after that. If it didn't close, I would have been out $100,000. Even if like it was because of my choice, like I was out of the money. So that's one way to get people to take you seriously.
And if they say no, on to the next one. Yeah,
and I mean right now it's like, there's deals out there right now. It's like if you're gonna try to lowball it and it's on the market, like you don't have a shot. They're not gonna take you serious. Doesn't matter if you have 100 million, 200 million, 500 million, a billion. But now that also might not be the right deal for you to buy either. So it's okay to walk away. It's okay for them to not take you serious. But if you find a deal that your level of conviction is through the roof on, and you want to show that you're serious and you believe in the deal, I'm not saying just go do this for any deal. But if you get to a property and your heart's, because you know it's which happens. When you do this enough, it happens. And when you get to that point and you got the conviction and you want the deal, do it. They're going to take you serious at that point. Makes sense? Next question.
This is like kind of a similar question.
Yep, next question.
That's all.
That was it? All right, that's all we got for this week. What do we at? Okay, so this is the 29th episode.
Mm-hmm.
I'm just like, every single week I'm astonished because I kind of forget during the week what episode we're at. I'm rolling into the room like, damn, 20. I'm like, damn, this is 20 already? This is 23 already? Damn, this is 25 already? 29? 29th episode of Justin Spaulding Show. Thank you guys so much for joining us. If I still haven't got any feedback, this is actually what I need to put on Instagram. I need to ask people again who should be a guest and just get more.
Because I have a guest every time.
Yeah, every time. What, get people to fly in here?
Yeah.
Do it remotely? Either way?
Zoom.
Both? All?
Skype.
Can we do live Teams or Zoom?
Yeah, we can.
All right, well, that being said, thank you guys so much for joining. If you are listening on YouTube right now, please, please, please subscribe to the channel. If you are listening anywhere else, please subscribe to that channel. Please, if you know of anyone that would get value out of today's episode, any of my content anywhere, please share it. That's really all I'm asking. I'm doing this for free. I'm doing this so that you can learn. I'm answering questions, all that stuff. So if you could just, my form of payment would be just recommend this to 1 or 2 or 3 or 4 or 5 people who would actually really get value out of it. Not just any 2 or 3 or 4 people that just could care less about the stuff we're talking about here, but anyone that could truly get value out of it. Please, 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 I'm gonna beg you, please share this channel, my feed, my Instagram, all that stuff. Thank you guys so much. Hope you enjoy your weekend. We'll talk to you soon.